In this video, I'm going to be explaining how to use a Fibonacci to draw on your chart to determine the premium and the discount zone. So right here, you can see the Fibonacci. If you click on this, you can see Fib retracement. So I'm going to show you how to do that. So the Fib, as you can see, I talked about the structure in the previous live stream. And in that previous video, you can see that this right here was a lower high. This is a lower low, right? And then we created this high right here, and we failed to create a lower low, and then we broke structure. Now, what you do in order to determine your discount key level is you're working with the overall low, and then right here, after price broke the structure, creating a new higher high, now your range, the range you're working with now becomes this range low and this range high. Now you use the Fibonacci and you put it from this range low and you put it on this range high. Now right here, I'm going to make this a different color so you can see very clearly. If I click this, you can see the settings that I'm using for my Fibonacci. So you can copy that, screenshot this, and do the edits for your own Fibonacci retracement tool. You just need to click on this toolbar right here. If you click on this tool icon, it's going to bring this out. You can make the adjustments, and after that, now above right here is the premium, below right here is the discount. You want to buy at discounts. Now you can see, what do you see beneath this discount? Inefficiency. Now this inefficiency is a drawn liquidity. After price does an expansion, it usually leaves an inefficiency. Those inefficiencies are areas that price could potentially retrace back into, and look at how this inefficiency is resting in the discount position. And look at how nicely price came into that inefficiency. So this is how you can draw it, and then I'll show you moving forward. You can also see right now you're working with the overall low, because this high right here, after we created a new high, this new high right here did not break structure right here. It took liquidity. What do I mean by that? If this candle closed above this high, that would have been a break of structure. But the fact that it didn't close and it used the wicks to run above this high, it is a run on liquidity. So this low remains our low. And then what we can do is we can use the new wicks, right? We use the new wicks resting above here. So this right here is called wicks. This right here is called candlesticks. Now we can put the Fibonacci at the wicks and then the low right here. And look right here. This is our buy zone, our accumulation zone, still resting in the discount key level, and price came back, retested, expanded higher. So if I was to look for any potential areas to get into this right now, even though I don't want this coming back down, I just want to see an expansion into this inefficiency, because this inefficiency is the drawn liquidity attracting price to come to the upside. So if this doesn't make sense to you, I'm still going to throw more light in more videos explaining inefficiencies and how to use your discount and the premium for accumulation and for distribution. What do I mean by accumulation and distribution? Accumulation is basically when you are buying. Like when price came into this discount, you are accumulating, right? Now, when price came into a premium, you are distributing, means you are taking profits, you are selling, right? So that is basically the explanation. And in the next video, I'm going to throw more light.